It's February 2026. Right now, as you're watching this video, something unprecedented is unfolding in the global financial system, and most Americans have no idea it's happening. In the past 72 hours, Treasury yields have spiked again. Mortgage rates are refusing to come down, despite the Fed's assurances. Your credit card interest just hit another record high. And if you've been watching your 401k, you've noticed something isn't quite right. The mainstream media will blame inflation. They'll blame the Fed. They'll blame corporate greed. But there's a bigger story they're not telling you, one that started quietly in Beijing and is now shaking the foundations of American finance. As of November 2025, China's holdings of US Treasury bonds have plunged to $682.6 billion, the lowest level since September 2008, during the depths of the financial crisis. Let me put that in perspective. At their peak in November 2013, China held $1.32 trillion in US debt. That's a decline of 47%. They've shed nearly $640 billion in American bonds over the last decade. But here's what should make you pay attention. They didn't just stop buying. They're actively selling, and they're doing it even though bond prices have fallen significantly since 2022. In finance, there's an old saying, no one sells at a loss unless they see something worse coming. Today, we're going to decode exactly what China sees on the horizon and why it matters to your mortgage, your savings, and your financial future. Because what's happening in February 2026 isn't just about two superpowers. It's about the end of an era, and you're living through it in real time. To understand why this is happening, you need to grasp one fundamental concept. Bond prices and interest rates move in opposite directions. This is the iron law of fixed income markets, and it's crushing China right now. Here's the logic. China bought most of their US Treasuries between 2008 and 2020, when interest rates were at historic lows, sometimes below 2%. They locked in bonds paying 1.5%, 2%, maybe 3% yields. Then came 2022. Inflation hit 9%. The Federal Reserve panicked and jacked interest rates from near zero to over 5%. In just 18 months, the fastest rate hike cycle in 40 years. When new bonds pay 4 to 5%, who wants your old bond paying 2%? The market value of those bonds collapsed. A bond China bought for $1,000 in 2015 might only be worth $800 or $850 today. Here's the brutal math. If you bought a 10-year Treasury in 2020 at a 1.5% yield and interest rates jump to 4.5%, your bond loses approximately 20 to 25% of its market value. That's basic bond duration mathematics. China is sitting on hundreds of billions in unrealized losses. So if China waits until maturity, say, 10 or 20 years, they get their full $1,000 back. But they're not waiting. They're selling now, taking losses of 10 to 20% on billions of dollars. They're crystallizing losses that they could avoid by simply holding to maturity. Why? 3 words: liquidity, logic, and leverage. First, liquidity. China's property sector is still fragile in 2026. Evergrande collapsed. Country Garden teetered. The People's Bank of China needs cash now to prop up banks and prevent contagion. They need dry powder. Second, opportunity cost. By 2025, the 10-year Treasury yield sits around 4.2%. But here's the problem. U.S. inflation is running at 2.5 to 3%. That means the real return after inflation is barely 1 to 1.5%. For China, that's a return-free risk. They're realizing the U.S. government is the world's largest borrower with $38 trillion in debt and counting. The Congressional Budget Office projects the deficit will hit $2 trillion annually by 2028. Looking at this and asking, do we really want to be the lender to a country drowning in debt? The answer, clearly, is no. But there's a darker reason behind China's exit, one that has nothing to do with interest rates and everything to do with geopolitical survival. February 24th, 2022. Russia invades Ukraine. Within 48 hours, the United States and its G7 allies did something unprecedented. They froze $300 billion in Russian foreign reserves. Think about that. Russia held those reserves in Western banks, thinking they were safe, liquid assets. With a few keystrokes, that money became untouchable, trapped in the digital vaults of the enemy. Beijing watched this very carefully, because the message was crystal clear. The US dollar is no longer just a currency. It's a weapon. And here's what makes this terrifying for China. Those Russian reserves weren't frozen because of a legal ruling. There was no trial, no due process. It was a political decision, executed through the banking system with surgical precision. Fast forward to 2026. Tensions between the US and China are at an all-time high. The South China Sea is a powder keg. AI chip sanctions are tightening. Taiwan remains a flashpoint. The US is openly calling China a strategic competitor. Now ask yourself, if you were China, would you want $700 billion sitting in American banks that could be frozen overnight if, say, you moved on Taiwan? Logic says, diversify. No, and that's exactly what they're doing. But here's where it gets interesting. The money isn't just disappearing. It's being repositioned. Watch the data coming out of Belgium and Luxembourg. Holdings of US Treasuries in these tiny countries have surged in recent years. Why? Because Euroclear, the European clearinghouse, is based there. China is likely moving assets into these neutral financial hubs. It's harder for Washington to seize assets held through European intermediaries than through direct holdings at the New York Federal Reserve. It's financial chess. And China is moving its pieces off the board. So if China isn't buying US debt, where is the money going? Let's follow the trail. Gold. China's central bank added 27 tons of gold in 2025, continuing a 14-month buying streak. Their official reserves now stand at approximately 2,306 tons, worth over $310 billion. But here's the critical insight. Gold has no issuer. No government controls it. No president can freeze it with an executive order. It's the ultimate sanctions-proof asset. The BRICS currency. In January 2026, something remarkable is happening. The BRICS nations, Brazil, Russia, India, China, and South Africa, along with new members like Saudi Arabia and the UAE, are preparing to launch a gold-backed trade settlement system called the Unit. This isn't a conspiracy theory. According to multiple financial sources, combined BRICS gold reserves now exceed 6,000 tons, with Russia holding 2,336 tons and China holding 2,298 tons. The goal? Trade without the dollar. Oil from Russia. Lithium from South America. Manufacturing from China. All settled in a gold-backed digital currency that bypasses the US banking system entirely. Think of it as a financial Berlin Wall, except this one's being built to keep the dollar out, not to keep people in. Commodities and resources. China is also converting paper promises into hard reality, buying copper mines in Africa, lithium deposits in South America, oil fields in the Middle East. They're moving from a financial economy back to a resource economy. Because when tensions rise, you can't eat a treasury bond, but you can power your economy with copper, oil, and rare earth elements. Now here's why this foreign policy chess match lands on your doorstep. When China dumps $688 billion in treasury bonds, they flood the market with supply. Basic economics. When supply exceeds demand, prices fall. When bond prices fall, yields rise. As of early February 2026, the 10-year Treasury yield is hovering around 4.2 to 4.3%. That might not sound dramatic, but remember, Treasury yields are the benchmark for all U.S. interest rates. Mortgage rates are typically the 10-year yield plus about 2%. So when the 10-year hits 4.2%, mortgage rates sit at 6.1 to 6.2%. Compare that to 2021, when you could get a 30-year fixed mortgage at 2.8%. What does this mean for you? A $400,000 mortgage at 2.8% costs about $1,640 per month. The same mortgage at 6.2% costs about $2,450 per month. That's an extra $810 per month, nearly $10,000 per year, just in interest. Multiply that across millions of American homebuyers, and you see the scale of the impact. For a young family trying to buy their first home in February 2026, this is devastating. That dream home that was affordable 3 years ago now requires an extra $200,000 in total interest payments over the life of the loan. That's a college education. That's retirement savings. That's generational wealth gone. But it gets worse. The US government itself is paying the price. In 2024, the government spent over $1 trillion just on interest payments on the national debt. That's more than the entire defense budget. By 2026, that number is accelerating. When foreign buyers like China exit the market, who picks up the slack? The Federal Reserve can print money to buy bonds, but that risks reigniting inflation. Or the government raises rates even higher to attract domestic buyers, but that crushes housing, car loans, and economic growth. We're trapped in what economists call a debt spiral. Higher rates mean higher interest costs. Higher interest costs mean bigger deficits. Bigger deficits mean more borrowing. More borrowing means higher rates. And China just walked away from being our lender. Let's be clear. China's $688 billion settlement wasn't a mistake. It wasn't irrational. It wasn't even necessarily hostile. It was logical self-preservation. They looked at the Russian asset freeze and realized the rules have changed. Financial reserves aren't just economic tools anymore. They're hostages in a geopolitical standoff. They looked at US debt ballooning to $38 trillion and accelerating deficits and thought, this doesn't end well. And they looked at their own vulnerabilities, property market instability, banking fragility, demographic decline, and decided they needed liquid, tangible, unreachable assets. So they're pivoting from treasuries to gold, from the dollar system to the BRICS alternative, from financial dependency to resource security. The question isn't, why is China selling at a loss? The real question is, what do they know about the next 5 years that we don't? Because when the world's second largest economy, the world's largest manufacturer, and the world's biggest holder of US debt starts building a lifeboat, maybe it's time to ask why. Here's what's happening right now in February 2026. The global financial order that's existed since 1944, since Bretton Woods, is fracturing. The assumption that everyone needs dollars, that everyone wants treasuries, that American debt is the safest asset on earth, that assumption is dying. The 80-year era of unquestioned dollar dominance is ending. Not with a bang, but with a series of calculated exits. China's just the loudest alarm bell. The world is splitting into two financial systems, one based on dollars, debt, and digital dominance, the other based on gold, commodities, and self-sufficiency. Your retirement account, your mortgage, your savings, they're all priced in dollars. The question is, how long before the rest of the world decides they'd rather hold something else? If you found this analysis valuable, check out our deep dive on the BRICS gold-backed currency and make sure to subscribe, because the financial order is shifting faster than most people realize. The world is changing. Make sure you're ready.